Welcome to Smart Investing with Nosa. This podcast is hosted by me, Nosakare Ugiagbe, and in today's episode, I'll be talking about hindsight bias and how it affects investment decisions. But before we begin, I believe it's in order to check on you, the listeners, to know how you're doing. I hope everyone is doing okay. I hope things are starting to go back to normal, at least to an extent, in your respective cities. For me in Stuttgart, things are getting a little better. A lot of public service facilities have started to open up. Even at work, we have more projects coming in. I'm a lot busier right now than I was a couple of weeks ago, or at the time I made the last episode of the podcast. So yeah, that's something to be happy about. As I told a couple of friends recently, the biggest flex of 2020 has to be having a job or a business that's still operational and being healthy. I mean, you just can't take those two things for granted at this point. So I guess that's something to be thankful for. And one last thing I'd like to say is that you shouldn't take the coronavirus for granted. The fact that things have started to open up in your respective cities doesn't mean the coronavirus is gone. It's still very much out there. It's still killing people. And so we should be mindful of that. My main inspiration for this episode was a couple of transactions that I made personally for my investment portfolio and how the hindsight bias could have affected them if I wasn't mindful of it. So on the 2nd of July, I invested in 5 individual entities, 5 specific securities. I know this is a bit counterintuitive, or this is a bit hypocritical, because if you've been listening to my podcast or if you've been reading my blog, you would know that I am usually anti-stock picking. I am an advocate for investing in indexes or in index funds, because that way you are able to reduce your exposure to any specific number of securities. You're able to obtain diversification benefits at a relatively low level of cost. So that's the reason why I advocate for people to invest in index funds. Anyway, so this time I went against my principle and I invested in specific entities or individual stocks. And there were 5 particular entities in which I invested. And the first one was EXASOL AG. That's a German company. It's a global technology company, and it provides an analytics database or a data engine to basically help companies deal with data, help make their business processes smarter, and perhaps help them improve margins and profits. So this company is a relatively new company. I mean, it's a tech company, and it was listed. I think they had an IPO in May 2020 this year. So it's a really young company on the stock exchange, and their IPO price was around 9.5 euros. I think that was the price at which the market opened or closed on the date of the IPO, and it was well between the range of their expected IPO opening price. And since it's a new, I mean, generally IPOs tend to underperform. Hot IPOs, to be precise, tend to underperform the market, or even lose investor value, shareholder value, around 2 years after the IPO date. That's because since they are hot IPOs, they tend to be oversubscribed, and investors tend to pay more than they probably, or than the fundamentals would suggest. Anyway, so for this reason, I generally would not even encourage people, like ordinary retail investors like myself, like you, to participate in IPOs, in hot IPOs especially, because chances are that if you would have access to, if you would be able to get some allocations, then you would probably be paying a higher value than the fundamentals suggest. So the IPO price was 9.5. I invested at around 11.2 euros, and the current price as at close of the market on Friday was about 14.4 euros. And so that's a 20.8% gain in the 2 or so weeks, in the 3 weeks since I invested in it. And it's easy for me to say that I knew the price was going to go up, but that would be false. There was no way I could have known. So I was simply investing in this company because of its fundamentals. I read about it. I was very interested in what they do. I mean, data is the new gold, right? It's the new oil. So I was interested in what they do, and I see great prospects for an analytics database company in the next couple of years. So yeah, I expect them to do well going forward, and I expect to see a healthy return on my investment. The second company I invested in is called German Startups Group, also a German company. It's a venture capital provider. So it's a VC fund or a VC firm, and it provides or invests in startup companies around Europe. And it was listed in 2015, around the end of the year, November or December, I'm not so sure. So this company is actually behind a couple of popular brands that you may already know, such as SoundCloud and Delivery Hero. I think they exited their position in Delivery Hero through an IPO recently, or a couple of years ago. Anyway, so the IPO price was 2.79. The investment price was, or the price at which I got in was 1.62. Again, this goes to emphasize the point I made earlier that most IPOs, especially hot or oversubscribed IPOs, tend to underperform around 2 or so years after the IPO date. So the prices generally go down after the IPO because they are often oversubscribed, and investors tend to pay more than the fundamentals would suggest. In the long run, they may end up, the successful ones may end up growing to become monsters like the Teslas of this world, the Microsofts and Googles of this world. But most IPOs tend to lose value a couple of years after the IPO date. So as at Friday, the price was 1.68 euros. Remember, I got in at 1.62 euros. So that's a 3.7% gain in the 2 weeks that I have been invested in this position. The third company is called Sensyne Health. It's a UK-based company, and it's a clinical artificial intelligence company that improves patient care and accelerates medical research through software products and data. So this is another tech company using AI and data to improve outcomes for patients in the UK. And again, I was very interested in this theme. So data, AI, technology, and healthcare. It had its IPO that it was listed on the stock exchange in 2018, August, and the IPO price was 187.5 pence. As at the date I invested in it, it was 36.5. It was trading at 36.59 pence. So that's a significant decline from its IPO price just 2 years before. Again, this emphasizes what the points I made about IPOs earlier. However, as at Friday, the value had declined even further to 30.98 pence. So that's a 16.1% loss in the 2 weeks that I have been invested in it. This also goes to emphasize the risk associated with investing in specific entities. On the one hand, I am making a 16.1% loss in Sensyne Health, and on the other hand, I made a 20.8% gain on EXASOL AG, the German tech company. The fourth company I invested in is called Vivoryon Therapeutics. I hope I'm getting that pronunciation right. Anyway, it's a pharmaceutical company, and they basically develop medicines that target post-translational modifying enzymes, and they focus on Alzheimer's disease, cancer, kidney disease, and a couple of other diseases I was particularly interested in this because of the not just because of the industry, but also because of the region in which it operates. So it operates in Europe, but primarily in Germany and to an extent in the rest of the DACH region, that's including Austria and Switzerland. And one thing that's prevalent in Germany is an aging population, right? And most of the diseases, most of the issues that this company is trying to solve affect the elderly. So if they achieve any major breakthrough, they would have a very vibrant market in this region. So yeah, so this is also a relatively new company. I mean, I think it's been in existence for over 20 years or so, but its IPO was done in 2015. I think January 2015. Its IPO price was 19.6, and again, I think I'm starting to sound like a broken record. So at the investment date, the price was 3.975 euros. So from the IPO date in January 2015 to July 2nd when I invested, that's a period of about 5 years and 6 months. The company had lost about 80% of its valuation. Anyway, as at Friday, it was trading at 4.01 euros. So that's about a 0.88% gain in the 2 weeks that I have been invested in it. And the fifth company in which I invested, and this is where it gets interesting, because unlike the first four where I was investing to hold for the long term, I was investing based on fundamentals and my interest in the industries in which they operate, and based on some analysis of those fundamentals and my expectation that in the future, if these companies turn out to be successful, their share prices would appreciate so much. And another factor I consider was the fact that most of them were trading at significantly lower prices compared to the prices on their IPO dates or when they just got listed. So the fifth company is called Amigo Holdings. It's a UK company, and it was established as a mid-cost guarantor loans lender. So you know how most banks today would determine your eligibility for a loan based on your credit score or your financial history or records. For them, they're taking it old school. So they're going back to the old times where a bank would give you money or give you a loan only if you provide a guarantor, someone to stand or guarantee the loan in case you are unable to meet your obligations in the future. So I mean, you can imagine why this would appeal to a lot of people. So it basically tries to cater to all of those people who may have been excluded from the system, from the current system that banks operate. So people who typically won't be able to get loans from banks. I mean, there are banks in Germany, for example, that denied me services simply because I hold a Nigerian passport, right? So when I just moved to Germany, my employer had made arrangements or had hired a relocation agency to help me settle down in Germany. So they helped me with processing my visa application, with getting my work permit, my EU blue card, and with getting an apartment. So they made an appointment with a certain bank in Germany. The bank was made aware of my situation. Hey, he's an expat worker. He's coming to Germany for the first time. He needs a bank account and so on. And so they were made aware. And eventually, when I showed up at the bank, everything was going well. They offered us seats, they offered us drinks, and they asked for the documents. So they told the relocation agent all of the documents they would need from me. So as soon as I provided my passport, the guy who attended to us, I think he stepped out, then came back and told us, well, sorry, he gave some silly excuse that I didn't have a permanent resident status yet in Germany, so for that reason he wouldn't open an account for me. The relocation agent was shocked because it wasn't the first time he was dealing with expats who didn't have permanent residence status, right? I would later find out that it wasn't just unique to me. It happened to all other Nigerian expats working in Germany. So you go to that particular bank, they find out you're Nigerian, they deny you service. Anyway, this bank, Amigo Holdings, basically caters to people who banks like this or other banks for some reason would usually not cater to. And due to the coronavirus crisis, and perhaps they had underlying issues before this, they went through a really tough time. There were lots of customer complaints that's going to cost them millions or possibly billions of pounds. They had disputes at the board level. I think the founder, who indirectly owns about 61% of the company, tried to change the board, and he made a promise that if his bid to change or to replace board members was unsuccessful, he was going to sell all of his holdings. So information that one of the founders is going to sell 61% of his holdings would definitely move the market, right? Again, this company recently got listed on the stock exchange. So it had its IPO in June 2018. And on that date, it closed at, I think, around 310 pence, British pence. But as at the date I invested in it on July 2nd, it was trading at 5.16 pence. That's a lot of money lost over a period of 2 years. Of course, some of the decline was caused by the coronavirus crisis. I think just before the market crashed in March, it was trading at around 70 or 68 pence. Anyway, so as at the date I got in, it was trading at 5.16 pence. And what's even more interesting is that on the third day, by the end of the third day, the market closed at I think 13.72. So I sold my holdings at some point during that day. So that's about a 125% gain in just 2 days. So it made me wonder, what if I had held on to, or what if I had invested all of my cash, all of the money I invested in the other 4 companies in this single security? I mean, I expected an upside, right? I expected that the market had overreacted to all of the negative news surrounding the company, customer complaints, the fact that the founder was selling all of his holdings since things didn't go his way at the board level. And so since I knew this, why didn't I just, invest all of my money in this company? I would be 125% richer now, and I could have, since I sold after 2 days anyway, I could have invested the rest of the money the way I wanted. I could have put them in the same companies I have now invested in, or in the other 4 companies I invested in. And the answer to the question, what if, or why didn't I do this, is in 2 folds. So 2 reasons. Basically, the first one is diversification and risk reduction, right? So investing all of the cash I had on that date in one company, Amigo, would have exposed me to a lot more risk than investing in 5 different companies. Investing in 5 different companies is already risky. Remember, it's already against my principle of investing in broad-based indexes or index funds. So I was already taking a high level of risk by investing in 5 individual securities. Investing all of that money in one would have been a significantly higher level of risk, right? But I wouldn't bore you with talk about diversification and risk reduction. I mean, we've talked about this at length in previous episodes or even in articles on my blog. So the second reason I didn't, or I couldn't have placed all of my bets on Amigo Holdings, is hindsight bias. Hindsight bias is basically a cognitive error. It's a bias based on the fact that outcomes that actually occur, are more readily evident, are more obvious to you than outcomes that did not occur. So people may see past events as having been predictable or reasonable to expect because it actually happened, right? It's in the past. So you're like, oh yeah, I mean, it's obvious. We should have known it was going to happen because it happened. So it's fresher on your memory. It's easier to commit it to memory. So in the same vein, people tend to remember their own predictions of the future as more accurate than they actually were because they are biased. So they are basically biased by the knowledge of what has actually happened already. So they tend to forget countless potential outcomes or potential possibilities because those possibilities did not happen. And this is why it's easy for someone to beat himself up like, oh wow, why didn't I just put all of my assets in Amigo Holdings since I knew or I expected that it was going to do well. Yeah, I had that expectation, but how sure was I? I wasn't 100% sure, right? I wasn't there was no I don't have a crystal ball that tells me, oh yeah, you're right about this 100% guaranteed. And the fact that I was right and the fact that the returns were so high and over such a short period would make it easy for me to say, oh wow, why didn't I just do this? But there's no way I could have known that. There's no way I could have known that it would go up by such a high margin. Perhaps I was even expecting 20-30%, and then I got 125%. So and this 125% return on Amigo in 2 days was just one possible outcome out of a number of different outcomes. And I mean, the prices could have declined further, or the company could have gone into bankruptcy, leading to suspension of trading and the risk of me losing all of the amount I invested in the company. So I didn't make a mistake by not investing all of my cash in Amigo. Thinking about it is just me letting my hindsight bias play a fast one on me. It's just like people who say if you had invested $100,000 or $5,000 in Bitcoin in 2000 and whatever, 5 years ago or whenever, that today you'd probably be a billionaire or be a multi-millionaire. And there are other instances in which the hindsight bias plays out in your daily life. For example, Americans would say, oh, what if we had elected Hillary Clinton instead of Donald Trump? Would fewer Americans have died from the coronavirus? Well, the truth is, we could have, or they could have, but they did not, right? And there's no way they could have known the eventual outcome with certainty. There's no way they could have known with certainty that Donald Trump would be as bad a president as he has been. I mean, a lot of people expected that he would stand up to the occasion. He would rise up to the occasion, and he would surround himself with intelligent people, and he would take their advice, right? So now that you know what the hindsight bias is, and you know that it can happen, or it in fact happens to everyone, it is not a bias that you can cure or that you can get rid of or be immune to. So you probably have it already. You will probably always have it, and it will probably always affect your decisions and how you review mistakes that you make in your life, or how you review good outcomes. The CFA text, the CFA study material on behavioral finance, recommends certain ways to detect and to cope with the hindsight bias. Remember, you cannot solve it, you cannot get rid of it. So the best you can do is to cope with it. And the first recommendation is to be aware of the possibility of hindsight bias. Now you know that you are subject to hindsight bias, and you will be prepared, or you would recognize it whenever you see past events as having been more predictable and reasonable to expect, because you know, oh yeah, it's because it actually happened. That's why I think, well, it's reasonable to expect that it would have happened. So the second recommendation was that you should carefully record and examine your investment decisions. So in my case, I understood, and I listed why I was investing on Amigo Holdings, right? I listed why I was betting on the company, and my reasons were, well, my expectation that the market was overreacting to the negative news, that my expectation that the market was also overreacting to the fact that the CEO was selling his shares. My expectation that the market overreacted to the impact of the coronavirus on the business. And I also had solid reasons for investing in the other securities in which I invested. So even if something bad had happened, even if I had lost money on the Azimo trade, I would have been able to deal with it because I knew I was taking on a risky investment and I had valid reasons for doing it. So if things had gone bad, well, okay, I was wrong because I understand the risk and return relationship as it relates to equity securities. And the final recommendation is that you should constantly remind yourself that markets move in cycles, right? So good managers or investors stay true to their strategies through good times and bad times. So this would help you deal with short-term fluctuations in security prices, because so once you understand hindsight bias and you've documented your reason and your rationale, your analysis, your justification for making certain investment decisions, you would be able to stay or stand true to those decisions because you have a backup. Okay, even if there's a short-term fluctuation, in the long run, things should go as expected. This episode has turned out to be longer than I planned for, so I'll be bringing it to an end here. Thank you very much for listening once again, and feel free to reach out to me if you have questions, comments, or if you have points you would like to discuss, or if you like topics you would like me to address on the podcast. Also, if you would like to appear as a guest on any of my episodes to talk about investing or making smart investment decisions, feel free to reach out to me as well. You can reach me on Twitter, on LinkedIn, or on Instagram. The addresses are included in the description to this episode. So thank you, and continue to stay safe out there. And remember, the coronavirus is not yet gone, so don't take it for granted. Don't take the fact that businesses are starting to open up to mean that the virus is gone. You should have as much respect for the virus today as you did in March or April. Have a good one.